Hello everyone, welcome to Finance for Engineers course. In earlier lecture, we have discussed about the significance of financial statements prepared by the business organization, where we understood that it aimed at providing financial information about a business to meet the information needs of the various decision makers. It has been emphasized that various users have diverse informational requirements. Instead of generating particular information useful for specific users, the business prepares a set of financial statements which is general, satisfies the informational needs of the users. Further, we discussed about the trading and profit and loss account, which is also known as income statement. It shows the financial performance in the form of profit earned or loss suffered by the business, while balance sheet shows financial position in the form of asset, liabilities, and capital. Now, next point of discussion is cash flow statement. The third important statement prepared by the business firms. Students, cash plays a very important role in the economic life of a business. A firm needs cash to make payments to its suppliers, to incur day-to-day expenses, and to pay salaries, wages, interest, and dividend, etc. Thus, it is very essential for a business to maintain an adequate balance of cash. Thus, management of cash is very essential. There should be focus on movement of cash and its equivalent. Cash means cash in hand and demand deposits with the bank. Cash equivalent consists of bank overdraft, cash credit, short-term deposits, and marketable securities. This cash flow statement is very significant. Why? Because it reports a company's inflows and outflows of cash. This is important because a company needs to have enough cash on hand to pay its expenses and purchase assets. The cash flow statement measures how well a company generates cash to pay its debt obligations, fund its operating expenses, and investments. The cash flow statement also provides insight as to whether a company is on a solid financial footing. Thus, it can be said that the primary objective of cash flow statement is to provide useful information about cash flows, inflows, and outflows of an organization during a particular period. This information will help the users to assess the ability of the enterprise to generate cash and cash equivalents and the needs of the enterprise to utilize those cash flows. There are some benefits of these cash flow statements. It aims at highlighting the cash generated from various operating activities. It helps in planning the repayment of loan schedule and replacement of fixed assets, etc. It can be used as the basis for the projection of future investing and financing plans of the enterprise. It helps to ascertain the liquid position of the firm in a better manner. Banks and financial institutions mostly prefer cash flow statement to analyze the liquidity of the borrowing firm. This statement has in efficient and effective management of cash. The management generally looks into this cash flow statement to understand the internally generated cash which is best utilized for payment of dividends. It is also useful in evaluation of cash position of a firm. There are some key features of cash flow statement. It shows the increase and decrease in cash. It is expressed over a period of time, an accounting period, that is, it can be for 1 year, 1 quarter, etc. It contains three sections, that is, cash from operation, cash used in investing, and cash from financing. It shows the net change in the cash balance from start to end of the period. Now let us see the three important components of cash flow statement. The first is operating activities. Cash flow from operating activities are primarily derived from the principal revenue generating activities of the enterprise. Few items of cash flow from operating activities can be said: the cash receipt from the sale of goods and rendering services, cash payment to the employees or workers in the form of salary and wages, cash receipt from royalties, fees, commission, and other type of revenue, cash payment to the supplier for goods and services, cash payment or refund of income tax. Next is investment activities. Investment activities refers to transactions that affect the purchase and sale of fixed or long-term assets and investments. And the example here of cash inflow from investing activities are cash sale of plant and machinery, land and building, etc. Cash sale of investment made in shares and debentures of other companies. Cash receipt from collecting the principal amount of loan made to third parties. Some examples of cash outflow from investment activities are purchase of fixed assets, that is, land, building, furniture, machinery, etc. Purchase of intangible asset, that is, goodwill, trademark, etc. Purchase of shares and debentures. Next activity is financing activity. The third section of cash flow statement that reports the cash paid and received from activities with non-current or long-term liabilities and shareholders' capital. Few examples of cash inflow from financing activities are issue of equity or preference shares for cash, or issue of debenture or bond. Example of cash outflow from financing activities are payment of dividend to shareholders, repayment or redemption of debt, buyback of equity shares. So these are the three important activities which are considered in a cash flow statement, and this is the format of cash flow statement which is prepared by the business organizations as per their requirement. So now here you can see sample corporation statement of cash flows. This cash flow statement is prepared for the year ended 31st to December 2020. You can see here cash flows from operating activities, cash flows from investing activities, cash flow from financing activity. And by adding all the three, we may get net increase or decrease in cash. In that, we have to add cash at the beginning of the year, the cash at the end of the year. So, this is a statement which is very important, which helps us to understand about the cash inflow and outflow of a particular organization. Now, the next is about the steps in accounting cycle. Students, preparation of financial statements is a last step in accounting cycle. The closing of the accounting cycle provides business owners with comprehensive financial performance reporting that is used to analyze the business. Basically, preparing these statements is what financial accounting is all about. The accounting cycle is a basic process for completing a company's bookkeeping task. It provides a clear guide for the reporting, analysis, and final reporting of business financial activities. Students, this accounting cycle starts with different business activities events. Bookkeepers first analyze the source document, that is, proof concerning to the transaction like voucher, receipt, bills, etc. Then record it in the journal. An accounting journal is just a logbook that contains a chronological listing of a company's various transactions and events. The accounting journal serves to document business activity as it occurs. This means that source documents are reviewed and interpreted as to the accounts involved. Then they are documented in the journal via their debit credit format. The journal is not sufficient by itself to prepare financial statements. That objective is fulfilled by subsequent steps, but maintaining the journal is the point of beginning towards that end objective. Now, the next step is transferring data from journal to ledger, and this process is called as ledger posting. Means to copy the entries listed in the journal into their respective ledger accounts. After all transactions have been posted from the journal to the ledger, it is a good practice to prepare a trial balance. A trial balance is simply a listing of the ledger accounts along with their respective debit or credit balances. The trial balance is not a formal financial statement but rather a self check to determine that debit and credit are equal. Then, the last step in the accounting cycle is preparing financial statements. They will tell you where your money is and how it got there. So, this is about the various steps that one should follow while writing the books of accounts, and which will give you an idea about the business activities happening during a particular accounting year or financial year. Now, here, brief explanation is given concerned with the books that are maintained by the accountant. This is a first book, primary book, which is also known as original entry book, and the process of recording transaction in journal is known as journalizing. So this is the format of journal. Date column is there, then particular. LF is nothing but a ledger folio. That is the page number of ledger on which the entry has got transferred or posted, debit amount and credit amount. This is the ledger. It is a book which contains a set of different accounts. It organizes the transactions recorded in journal under their respective account head. Posting is the process of transferring the journal entries to their corresponding accounts in ledger. So here one example is mentioned in front of you. The format you can see here of cash account. You can see here debit and credit. DR is nothing but debit and CR is credit. See here columns, date column, particular, JF, that is journal, folio, that is the page number of journal on which that entry was first got recorded. Then the amount column, and then on again credit side you can see the same columns copied in a same format, same sequence, that is date, particulars, journal folio, and amount. That means the account which we have to give effect of debit, we will write on a debit side, and the accounts which have credit effect, we have to mention on a credit side. So this is the example of cash account and the format used for writing the entries into ledger. This is a trial balance. It is prepared to check not only the arithmetical accuracy of ledger balances, but also to take an overview of the operations of the business as on a particular date. It is prepared on the basis of quarterly, half yearly, and yearly basis as per the requirement of the organization. A trial balance contains the elements of financial statement, that is asset, liability, equity, income, and expenses, the total of debit and credit in the account must be equal. It is a statement that consists of all the debit and credit balances of the various accounts in ledger on a particular date. Here is the format of trial balance normally prepared by the business organizations. It is on a particular date. So only three columns you can see here. We are not mentioning date. Why? Because this particular trial balance is a statement and not an account. For account, that is for late journal and ledger account, we need to mention the date. But here it is a statement which shows the position of the organization concerned with a debit account and a credit account. That's why only three columns here presented: particulars, debit amount, and credit amount. And then is the finance account or financial statement, which we have discussed in earlier lecture. Now let us move to accounting principles, the next important point which one should know about, because these are very important, widely accepted set of rules, conventions, standards, and procedures for reporting financial information as established by the Accounting Standard Board, which is called as GAAP, that is generally accepted accounting principles. These are the common set of accounting principles, standards, and procedures that companies uses to compile their financial statements. These principles are nothing but those rules of action or conduct which are accepted universally by all accountants in recording transactions in the books of accounts. Now, the next is, these accounting principles has got divided into two main categories. First is accounting concept and then accounting convention. Accounting is nothing but a language of business. In the absence of systematic approach, accountants may use their own language and it may not be understood in the same way or same sense by all the concerned parties, and therefore, with a view to make accounting language a standard language, certain accounting concepts have been developed over a course of period. These accounting concepts are general guidelines for sound accounting practices. Accounting concepts. These accounting concepts are assumptions and conditions on which the whole accounting structure stands. They are the predetermined conditions which a bookkeeper must keep in mind while recording transactions in the books of accounts. So here you can see nine concepts have mentioned. First is going concern concept. Next is business entity concept, money measurement concept, cost concept, dual aspect concept, realization concept, accrual concept, accounting period concept, and matching concept. Then next is accounting convention. Accounting conventions refers to rules which have common acceptance and agreement in accountancy. That is, customs or traditions which guide or direct the preparation of accounts are known as accounting conventions, which play a very important role as it gives a guidance to the accountant while writing the books of account. So here you can see four accounting conventions: consistency, disclosure, conservatism, and materiality. So students, we will discuss these accounting principles in our next lecture. Thank you.